Hey guys, Mike here. So happy Sunday, and this video is going to set us up for the week here, right? We'll talk about earnings, a lot of economic data, huge week coming up with CPI, which we're going to touch on a lot in this video. FOMC meeting, we don't expect them to do a rate hike, but we'll see what they got to say anyway, if they're going to continue it in July or not, right? And then some things that just amaze me, right? There's a couple stocks you definitely, if you're in them, you want to pay attention and everything. There's something's going to happen here coming up soon. I want to show you and everything. And we'll also touch on Tesla because there's a few things I want to talk about that I didn't talk about in the previous video. But I did want to, this is amazing to me. I've talked about this, and you can just see this coming to fruition now, where now it's cheaper to buy than rent in only 4 major U.S. cities. Okay. And when we go through here, you can see if you're curious, maybe you live in these, right? So the typical home's monthly mortgage cost is lower than its monthly rent in Detroit, Philadelphia, Cleveland, and Houston. So if you're in those cities, you can actually buy versus rent. The rest of the major cities, I know like where I'm from and down to Miami stuff, is definitely cheaper to actually rent now. So, and then if you look coming down a little more, you'll see in all other major U.S. cities, San Jose, California, to Pittsburgh, renting was more affordable than actually buying. And so let us know if that's the case in your area. I know in my area, I told you I double checked it, like right around the corner, like 5 houses around the corner. Instead of selling the house, they decided to rent because they can get like $3 grand for rent. What's crazy though is, and they just want passive income. But I looked it up. If somebody was to buy that house, the monthly payment would be like $3,600. So it'd be $600 more than just to rent it. Which I can't imagine paying $36,000 just in a rent. That's mind-boggling. You get nothing for it but a roof over your house, roof over your head. Excuse me. But wow, no tax deduction, no equity built up, no nothing. Oof. Okay then. Anyway, this right here, and a lot of people are talking this in the comments, right? This is what we've been waiting on. I've been talking about this, and this is ISM Services PMI report on business prices, right? So basically what they're paying in or what's costing them to actually produce a service or a product, but this is the services part, right? Versus like U.S. personal consumption expenditures core price index, and that's for us, right? This is how much it's costing us. And you can see, obviously you've seen the ISM Services PMI fall off a cliff, right? What it's costing them for certain things, but then you see what it's costing us, you see it's stuck, right? Because the businesses are still charging us more. Now, one reason for this, obviously, and you can see in that chart, the orange line has never been this far above the blue line, ever, right? And this goes back to 1997. But one reason is the wage growth, right? And you can see right here, because I've told you about the sign still out in front of the stores. I'm sure you've seen it, and that's where we're at right now, right? And so you look in the past, this goes back to like 1997. That was the closest we'd ever been to it right there, but then it fell off a cliff, the wage growth tracker going through 2010, started to come back up, but then that major, obviously, when inflation hit, just rise was incredible, and now it's just stuck up there, right? It's trending down a little bit, but it is still stuck up there. And it's like I said, teenagers are making between $15 and $20 an hour now to flip a burger or a lifeguard. So something we ain't seen in a long, long time, if ever, I guess you could say. But again, this is needed. And I'm gonna go into this a little bit later on in this video of why this is needed and why this is going to make for, to me, the most interesting probably 18 months we've ever seen in the economy. And guys, before we continue, if you get anything out of this, please hit that thumbs up down there. I really appreciate it. And if you like the material here and the videos, think about subscribing. Now we get to get into this right here. So we talked about the AAII sentiment, right? And we know right now it's the highest it's been since 2021. And so bulls are coming back with a ferociousness. And then you look at, well, what's keeping the stock market going up? Well, when that sentiment changes, all of a sudden the exposure changes, right? So active managers are moving back in. It's been the highest since November 21 because what I tell you, if they miss out on any kind of run, they get fired, right? If they're wrong, it is what it is. But they'd much rather be wrong than sit here and have to explain to somebody, how come you missed out on all this run up, right? And so they've moved in, right? What's that done to the VIX? Absolutely just pushed all the way down since what? It hadn't been this low since February 7th, 2020. Okay, and in a bull market, normally a VIX will stay low. You'll get spikes in here and there when stuff happens, but it will stay low. So that's another argument people are making for a bull market, right? That it just keeps going down. And if it stays steady, let's say it gets between like 12 and 13, just stays there for a longer period of time, well, there you go, right? Then, of course, you'll have, the bears sit out there saying, wait a minute, How can a bull market be led by a company like Carvana, right? Which, of course, the used retailer issued a robust second quarter EBITDA forecast, which surprised a lot of people, including me. Now, of course, the stock's been going crazy, but the reason why the stock's been going crazy because this was just an absolutely hammer stock, but also the short interest on a small float on this was incredible, right? So, of course, you got shorts covering, and this is what Jim talked about, the guy who manages the volatility index, was you got to squeeze the shorts out, right? We've been seeing that on IWM. We're seeing this on other stocks, on other indexes. You got to squeeze them out. And the reason why it amazes me to see car companies actually going up is because of how expensive cars are, right? I mean, the average was 41,000 in January. It's gone up to 48,000 now, even though it's dropped a little bit, right? And when you look at the numbers, I'm not even going to make this up, and I'll show you. That means a 5-year loan with good credit at 6.4% is around $936 a month. That's before insurance and maintenance, right? And when you go on Carvana's website, you can type this in. Just type in 48,000. Even with $1,000, and it's a little cheaper because you do a $1,000 down payment, and so that's at $849. If you do a down payment, you go into excellent, you get down to maybe $800, right? And so that's for a 5-year loan, which is just crazy to me. But look at this right here. This is amazing to me to see this. And I'm obviously definitely getting older because I remember the age of paying between $200 and $400 for a monthly car payment, and that wasn't that long ago. Okay, this is the finance rate on consumer installment loans at commercial banks for auto loans that are 60-month loans. Okay, so 5-year loans. Look at this right here. We hadn't seen these kind of rates since before the financial crisis. And look how fast they went up. Look at the gaps up right there to the right. I mean, going from 4.75 upwards over 7%. That is amazing. And I found this report out right here about credit cards. And I'm going to talk about this in just a minute. But this just came out a few days ago. And the main takeaways, I zoom in for you, just look at this. The average interest rate for a new credit card as of Q1 2023 is 22.15%. Okay. Interest rate on business credit cards have rose even more, almost 25%. Amazingly, at 20.92%, the average credit card interest rate is higher than it has ever been since this has been tracked by the Fed going back to 1994. And you can see by this chart, I love a visual, the interest rate landscape for all new offers. And just look at that right there from Q3 of 2021 up. I mean, just a straight up cliff going from 18 to over 22%. And that may not sound like much, but you know as well as I do, at least half the country, if not more, is not financially responsible. They do not pay their credit cards off every month. They run them up. We pay for everything with credit cards, right? And what's amazing to me to see is that's what happens. People get more money and they go, oh, I'm good, right? Because remember, in our country, I don't know how it is in other countries, but in this country, it'll never happen to me, which i.e. means I'll never get laid off or lose my job or bad times is going to hit, right? So they just spend. Got this. I mean, trust me, my mom was the exact same way. That's the reason why she had terrible credit her whole life. But I mean, and understand, we already showed you what the delinquency rates are for younger people from like 18 to 35-ish, somewhere in that range, on car loans, on credit cards, right? It's going up, okay? And they got jobs right now. And that's why I say none of this is a problem until it is, but what's amazing, and this is what I can't wait to see. I don't know about you, the I guess, normalcy in a way will be here, what do you think, in about maybe 3 or 4 more months, if we do get student loans kicked back in, right? And all the COVID stuff goes away. It's still out there, believe it or not, it's floating around. They're just masking it with different names now. But if that goes away, student loans kick back in, right? And then you end up also having record credit card debt, which interest rates at record highs. Then you got higher rents than we've, I think, ever seen. Then you got higher mortgages than we've ever seen, right? So all these things at new highs. And so I just can't wait to see. I'm not wishing anything bad on anybody. I just can't wait to see how it works because all this is hedged on whether the Fed lowers rates, because whether they raise them again don't even matter at this point in time. What's 0.25 really going to do? It's if they hold them. And if they hold them through the entire 2024 and these mortgage rates and these credit card rates and these car loan rates and all that stuff stay up there or even continue to rise for that matter, man, I just want to see how people handle it. Now, I'm talking when I say people, like the 50% who are not financially responsible, like you still have to have them purchasing stuff because guess what happens? I grew up in a household who had terrible credit, 2 bankruptcies, all due to medical bills, not really their fault. and everything. Number one reason for bankruptcy in America, still to this day, even though that was like 35 years ago, still happening. But when your credit score is wrecked in America, man, it's a rough life for you. And if you know what I'm talking about, put it down in the comments. I remember that was my goal. It's sad to be a goal, but I was like, I will not have bad credit, because I saw what it did to my mom and trying to get a car or a credit card or anything. I mean, you're paying loan shark rates, man, and you can never save because the money you're supposed to be saving is going just to pay interest, right? And so I implore anybody that had been doing this like 2.5 years ago. Look, I don't know if there's going to be a recession, but the last thing you need to be doing is running up major credit card debts with interest rates like that, going out and buying a car you don't need at crazy rates, all that stuff, buying a home you can't afford, because the odds of you getting probably laid off may not be great, but if it happens, you're in deep trouble. Okay, I'm just telling you right now, I've been growing up my whole life in that mess. It's a mess, and if you ruin your credit score, good luck to you. It's going to be tough for you. I'm telling you right now. So just please pay off your credit cards. Keep your debt down, please. All right. So yeah, it's going to be interesting. Let me know what you think, what your predictions are on that. But, going into a couple of things I want to say about Tesla. One, I understand we're going to be coming to a supply area, but also within that supply area is going to be a gap. And it's a very small gap, but it's there, right around like 262-ish and somewhere. And so watch for that to get filled as it continues to move up. But also understand, look at the move we made up. If we bring up some fib levels, you can see that I'm drawing this from the low to the high where this whole stuff happened with the news and the massive sell-off to $100. And it's broken through what I call the golden pocket, 618, 6.5. It's broken through that. The reason why it's important because, you come over here, let's say for this move, let's just pull one up right here. You can see usually at 618, it hit 3 times before we did that massive sell-off, but 618 is a big fib level, okay? And so usually that's when you'll get either some consolidation, a pullback, something. When I say pullback, I don't mean 30%, I mean just a pullback where it starts consolidating itself and everything, and people start doing some profit taking and everything. But, the big thing is look at these moves. Like all the moves look the same. That's skyrocketed, that skyrocketed, that skyrocketed. And so, you have to have a breather, right? Especially if you're a long-term investment in this, you want it to consolidate and start building out some support at that level and then start to move up again. That's what you want. You don't want this parabolic crap to continue over and over. That usually makes for a fall. And so you don't want that. Again, that's the kind of market we're in. We'll have to see. And again, Tesla is one of those momentum stocks. When it gets moving, it's like a freight train, all right? And why? Because calls. Look at the 250 calls that came in on Friday. Right there at the end of the day. I mean, just rolling in hundreds of thousands of dollars, right? Look at this. Just rolling in 250, 250, 250. So keep that in mind. Don't be surprised to see this thing keep moving coming next week, even with all the stuff we got going on. Now, Apple, watch Apple, because Apple's interesting, right? It set that all-time new high. It sold off, then came back up, kind of got rejected off the previous all-time high that it had. But if it does continue to move down, then you're looking at 178, then 175 is a definite key level to watch on this one, because that's where you got one of those small gaps. It's left mini gaps behind on the way up. So keep that in mind on Apple, because it is obviously the most highly weighted stock out there. And then Netflix. I mean, what do you want to say? It just keeps moving up, right, to fill that gap. It has some huge days. I'll show you the news it put out Thursday night, Friday-ish is when everybody got it. And again, this one, it gets overbought up on the RSI on the daily. Takes a breather for a second and just keeps stair-stepping. It's taking basically an escalator up at this point in time. Let's just pretend that trend line is the escalator. See, and I also thought to myself, well, what's going on with the 200 moving average on this thing? Is usually this was a stock in the past that followed its 200-day moving average, and you can see it's pretty far above a 200-day right now, right? It hadn't touched it since like last October. And so, we'll have to see if we finally get a pullback to that at some point in time, as it's been moving up and they kind of meet at some point in time. That will definitely be healthy for the stock. And of course, the news they got was their U.S. signups rose by the most in over 4 years after they cracked down on the password sharing, which people thought it would do the opposite, but it did not. So people love Netflix, right? And then also, if you own these two stocks or thinking about getting these two stocks, watch out for Rivian. Obviously, it's been destroyed. As you can see, and then on Semiconductor, which is the opposite, it's in an uptrend because Rivian is being kicked off the NASDAQ 100, and then Semi is going on coming June 20th, which of course will give more exposure to on Semi going on to the NASDAQ 100, and Rivian, of course, coming off could also signal even more selling we had to see, so just keep that in mind right there. So if you're looking for another semiconductor, maybe do your research on that one and see if you want to do it. Now, earnings, you can see it's pretty bare, right? But watch out for Oracle. This is all about AI, right? Watch out for Lennar. This is one of the home builders. I showed you their stock this previous week. Watch out for Kroger. See what the grocery store chain's got to say. And watch out for Adobe for more AI news on Thursday. I think it's had a big move up. And then, of course, here's the economic data. You know, Monday, nothing. Tuesday, you'll have MFIB Business Optimism Index. And then we'll go with core inflation rate month over month. You can see no change estimated, but the year over year is supposed to drop from 5.5 to 5.3. And then, of course, we'll go with CPI. That's the inflation rate month over month, supposed to drop 0.2% or only increase by 0.2%. And then inflation rate year over year is supposed to be a big drop from 4.9 to 4.1. So let's watch that. The Fed really cares more about core, but again, the market's going to react whichever. And then, of course, keep moving on. Then, of course, next day, core PPI, and this is what the Fed likes to see, and this has actually been improving. And so they're expecting to go from 3.2 to 2.9. Eventually, this will filter down to us. And then, of course, PPI month over month and year over year, supposed to be big drops as well. And then, of course, what everybody cares about on the 14th and all that really matters is the Fed meeting and interest rates, right? They expect no interest rate hike, and then Jerome Powell will speak, and the market will go crazy, up 1% or down 1%, and then turn back and all that good stuff. People love playing that. And then the next day, you'll have continuous jobless claims, which we assume they already have. In their basket, initial jobless claim and stuff to see if it's slowing. All the Philadelphia manufacturing conditions and everything, which have been hot garbage, but the market didn't seem to care. And I'll show you a chart on that in just a second, proving that. Then you have retail data and stuff coming out, so we'll see if it's finally slowing down or is it still red hot on the services side or not. And then on the 16th, you'll have a couple of Fed presidents speaking, probably trying to talk the market down, but nobody's going to care. And then Michigan, consumer sentiment, all that good stuff. And when I talk about manufacturing stuff, you can see the number of consecutive months the ISM manufacturing new orders has been less than 50, which is never a good thing. I believe we're sitting at around 9 weeks now. And so you can see anytime we get to that level, there's been a recession. But then again, the past, I keep trying to tell people, remember back in the past, thanks to our government selling all those workers out, you know, they shipped it overseas to China. So we don't do that anymore. So I think, you know, that's why the economy, or the market, just says, who cares? Who cares how bad manufacturing is? It don't make up part of any of our economy, right? We care about the services, right? The experiences, all this stuff, the travel stocks, travel sector, things like that. That's what we care about, okay? And so just keep that in mind. That's why I think, you know, and again, I learned this too, how much of our economy actually was manufacturing 20 years ago versus today versus like services and stuff. And that's why people put in the comments, and I always say I'm willing to bet they're from manufacturing areas, saying, no, it feels like a recession around here. And it's like, I can believe that, right? But if you're in an area like mine or in a state like mine where it's just a lot of tourism, a lot of services, things like that, then, you know, you don't feel it, you don't see it. So, you know, that's just a thought of mine. Let me know what you think about that in the comments and stuff. So, and that could be throwing a lot of these recession indicators off. So that's what a lot of them are based off of. So anyway, hope you guys got some ideas. Let me know what you think about it all and stuff. Hit that like and subscribe button. As always, I appreciate it. You guys are the best. And I'll see you tomorrow.